The car market is, well, not doing a whole lot. Experian releases a quarterly report every quarter, and just this week they released their update for Q1 of 2024. And the results are promising in some regards and a bit disappointing in others. But before we dive into that, a quick refresher. Throughout this video, you'll hear the reference to things like super prime, prime, non-prime, subprime, and deep subprime borrowers. This is in reference to borrowers and their credit score. You can see here that super prime borrowers have the highest credit scores, while deep subprime borrowers have the lowest. So keep that in mind because it is important to take into account within the context of this overall Experian report. You can see here the total change in percentage of vehicles that are financed, and in the overall car market, this isn't changing a whole lot, but for used cars specifically, it's actually going down by quite a few percentage points. In 2023, 41.73% of used vehicles were financed. This goes down to 37.33% in Q1 of 2024. While on the flip side, the percentage of new cars that are financed is pretty flat. Leased vehicles have also increased by quite a lot over this year. Of the type of financing that people get, captive financing, so the financing through the dealership, is still the most popular form of financing, making up 31.29% of all financing. Which isn't surprising because of the fact that this is pretty much always the case. Dealerships in general get more of a percentage of the financing than things like banks and credit unions, but I'm going to be honest, I'm always a bit personally surprised by this, given the fact that credit unions have far better rates in this current economic climate. Now, obviously, the benefit of getting financing through a dealership or through captive financing is that oftentimes it's just easier, it's more convenient, and there are oftentimes incentives with dealerships that do offer financing, which is all a benefit as to why people may go this direction. But in recent years, as interest rates have absolutely skyrocketed, there has been a real incentive to go and price shop a car loan. And with this price shopping, I have found that credit unions have far better rates than traditional dealership financing. Now, as dealerships bring back incentives, this is probably not going to be as much as the case it has in recent years, but I do in general feel that credit unions are underutilized. And the data points to this being a bit of the case because they only make up 20.14% of all auto loans. And you can also see here that the amount of money financed through credit unions, so not just the accounts, but also the total amount of money, is going down year over year. And this is even larger with new car loans. You can see that 52.35% of new car loans are through captive financing, while only 13.27% are through credit unions. While on the flip side, credit unions take a much larger chunk of used car financing. Captive financing makes up only 8.68% of used car loans, while credit unions make up 27.98% of used car loans. The only lender higher is traditional bank. Now, on the topic of financing, the average borrower is still having to have a fairly high credit score, which you can see here. Now, going further into the lending and financing data, we can see that super prime borrowers are continuing to make up a larger portion of the market share for borrowers, while the market share of deep subprime borrowers have actually gotten smaller. In fact, the share of deep subprime borrowers has been cut in half over the last 6 years. In 2019, subprime borrowers made up 4.69% of borrowers, while today they make up 2.19%. And this is due to a handful of different things. It's because of higher interest rates, so it's more expensive to borrow money to buy a car. It's because the cost of cars is higher, so less people can afford to buy a car, especially people with poor credit. And it's of course because of tightening lending standards, which means that it's harder to get approved for a car loan than it was back in 2019. And this is all affecting the ability for borrowers to borrow money, which is why we're seeing more high credit borrowers borrowing money and less low credit borrowers borrowing money. When we peel back the curtain a bit more, we can see that the vast majority of new car borrowers are high credit score borrowers. And this is not only because of high interest rates. Even though new car interest rates are significantly lower than used car interest rates, they are still higher than they were back in 2019. But it's also predominantly due to the fact that new cars are just extremely expensive, and a lot of low credit borrowers just can't afford it. While on the flip side, you can see overwhelmingly that poor credit score borrowers are going to the used car route. But even with used cars, super prime borrowers make up the majority of borrowers. And even across the board, with used vehicles specifically, we can see that less and less people are choosing to finance, with every segment of borrower choosing financing less frequently. And well, the reason for that is what I just talked about a moment ago, and that is that interest rates are incredibly high, the cost for cars is still high, and tightening lending standards are still tight. But even in this current car market, where the car market is absolutely normalizing, with new car prices not going up at the same rate and used car prices going down, we are still finding that cars are unaffordable due to the fact that the monthly payment is still incredibly high. you can see here a breakdown of year-over-year car payments, as well as the amount that different segments of borrowers are financing and how much that monthly payment has increased year-over-year. Now, the average new car loan for prime and super prime borrowers has actually gone down year-over-year. But in the case of deep subprime, subprime, and near prime, that new loan amount has actually increased. But you can still see that across the board, monthly payments are incredibly high. And in fact, in the super prime borrower category, you can see that the actual loan amount for a new car has decreased by $733, and the monthly payment for that car has decreased by $3. But in the case of a prime borrower, the average new loan amount has also gone down by $156, but the average monthly payment has actually gone up by $6. You can also see the average new loan rate terms and the amount of interest that these loans are paying. Longer-term loans that are anywhere between 73 and 85 months are seeing significantly larger interest rates, while loans 4 years or less are seeing significantly lower rates. And this goes back to what I've talked about many times on my channel, which is if you're stretching a car loan out, not only are you going to have to pay more in interest because the loan is stretched out for a longer duration of time, but you're also going to have to pay higher interest on that loan because the longer the term, the higher the interest rate. So it is a double whammy in the worst way possible. You can see the same data here for used vehicles, and I find this to be really interesting because whenever it comes to new cars, deep subprime and super prime borrowers are financing very similar amounts. But in the case of used vehicles, you can see that the amount of car that's being financed actually goes up as the borrower's credit score also goes up. And you can see here that with deep subprime borrowers, even though they're financing the lowest amount of money, they're actually seeing the largest change in their monthly payment. And you can see here that with deep subprime borrowers, even though they're financing the smallest amount of money for their used car, their monthly payment is actually higher than most credit score groups. With a $534 monthly payment, the only group that's higher is subprime borrowers with a $536 monthly payment, and deep subprime borrowers' monthly payments have gone up by $26 year over year, while near prime and super prime are flat, and prime borrowers have actually gone down. But you can also see that while near prime and super prime borrowers' loan amounts have gone down by a few $100s, it hasn't impacted the monthly payment at all. You can see a further breakdown here, which isn't segmented out by borrower, it's instead segmented out by year, and you can see that the amount financed for a used car has gone down from 2023 to 2024, but you can also see that the interest rate being charged on this loan, as well as the monthly payment and the term of the loan, have all increased slightly. And this is impacting the overall car market as a whole, because you can see here that the total outstanding automotive loan balance has been increasing year over year since 2019. Back in 2019, there was $1.1 billion in total outstanding automotive loan balances. That has skyrocketed to nearly $1.5 billion over the last few years. You can also see that 30-day delinquency statuses are also up, with 2.72% of auto loans and leases past due, which is higher than we've seen since even pre-pandemic, while 2.71% of total auto loan balances are 30 days past due. 60-day data isn't quite as large as 30-day data, but it is still growing. And you can see here that the vast majority of 60-day delinquencies are with used cars, and they're also purchased from independent dealerships, which is something that I've talked about on my channel many times, and it's the idea of avoiding these independent dealerships that are buy here, pay here, because typically they tend to be predatory. Not only are you going to get charged an arm and a leg for the financing of the vehicle, but you're also going to be overcharged on the vehicle itself, which means that you're pretty much going to be underwater on that car the moment that you drive off the lot, and it's going to be extremely difficult to get ahead on that loan, which is why these loans fall delinquent faster and more frequently than franchise dealerships, because franchise dealerships don't have these exact same predatory practices. So what does all of this mean? Well, to me, it means that cars are still incredibly unaffordable, and this is particularly true with low credit score borrowers and low-income individuals. While cars are getting more affordable and the amount that cars are being financed for has technically gone down, interest rates are causing payments to stay high, and thus the decrease we're seeing in car prices isn't really being felt. And as a result of this, more and more car loans are becoming delinquent. But the truth is, none of this is new, and none of this data is surprising. Cars are unaffordable for a variety of reasons, and the reality is none of these factors have changed in 2024, so the car market hasn't changed either. And in my opinion, I believe that there's going to be two scenarios that could heavily impact the car market, and until one of these two end up playing out, I don't think that the car market is going to change that much. The first scenario is an economical shift, something like a recession. I've been in the camp for quite a long time that the US debt situation is simply unsustainable. And I think that at some point this is going to come to a head, and whenever it does, I think it's going to really impact the car market, and I think it could make cars significantly more affordable. And the second factor, which could come first, is a lowering of interest rates. Interest rates are incredibly high, and unfortunately, it doesn't look as though interest rates are going to be lowered significantly anytime soon. But once they do, it will absolutely affect the affordability of cars. And so in the meantime, if you are someone who wants to buy a car, then you should stick to the core fundamentals of buying a car in a strategic way. Number one is to price shop the loan. Don't go to the dealership for financing just because it's the easy route to go down. I highly encourage you to check out credit unions. Number two is to buy a car that holds its value well, or alternatively, buy a car that has already had the bulk of its depreciation. And number three, buy a car below market value. Never ever pay above MSRP. Try to get a discount on the car that you buy. But like always, you guys, I hope that you enjoyed this video. If you have any questions, comments, if you have anything to add, I would love to hear it, so make sure to leave a comment down below. And while you guys are at it, make sure to hit the like button, hit that subscribe button, and hit the notification bell, and I will see you guys in the next video.